My name is Sasha Orloff, and I am a payday lender. I'm not saying this as part of a 12-step program, and no, this wasn't the dream I had growing up as a little boy. I say this because I'm proud to be up here on stage in front of all of you and tell you, right here in the capital city of the state of the largest economy in our country, I'm proud to be a payday lender. The word payday loan might make you feel uncomfortable, even if you've never taken one out yourself. The industry is incredibly large, and it's important for a lot of people. So when we think about payday loans or lending money to poor people, in Bangladesh it's called microcredit, and here in the United States it's called payday lending. There it can win you the Nobel Peace Prize, and here it almost always gets you in a heated debate. But why do we hate payday lending so much? Why have we hated it for so long and not been able to fix it? Well, the solution until now has seemed less than obvious. We didn't know what to do. And this is usually a really good place to start, reimagining the way something could be if you redesigned it from scratch. A few years ago, I did just that, and today I'm running one of the most technologically advanced lending institutions in the United States, along with my stepbrother, Jake. And we happen to be smack dab right in the middle of an industry most people wouldn't dare enter. For everybody that wanted to help but didn't, 1 in 8 working Americans was left without a safe option for borrowing money. To give you a sense of size of this market, that's 275,000 payday loans every single day. This is a big industry, and we knew there had to be a better way. The problem is too big and affects millions of people's lives, and we just can't ignore it any longer. About 10 years ago, my desire to fix this problem started in rather uninspiring circumstances. A friend of mine passed me this book called Banker to the Poor, written by Dr. Muhammad Yunus. And it's within these pages that I could see that providing safe access to credit can help people improve their lives. Dr. Yunus would later go on to win the Nobel Peace Prize as the founder of the Grameen Bank and pioneer of microcredit, the lending of small amounts of money to poor people in the rural areas of the poorest countries. What started as a local experiment in Bangladesh has turned into a multi-billion-dollar bank that has been replicated in over 100 countries over the last 30 years. Dr. Yunus did what most people wouldn't dare do, and what banks definitely wouldn't do. He lent money to people that banks would never lend to, those that were deemed too high risk and simply not profitable. He simply changed the structure of the credit product, incorporated education, taught people about credit, taught them about the importance and the value of what good credit can do, and changed the dynamic of the loan from a transaction into a relationship with the customer. Change inspires change. So after agreeing to volunteer for the Grameen Foundation, I found myself in Honduras on a 6-month volunteer program and ended up staying for years of my life because I saw that the power of what safe credit could do in our communities. From there, I went to the World Bank's Consultative group to assist the poor in Washington, D.C. And from there to New York, where I worked for Citigroup. I was sitting in the building with a 200-year history of financial services, risk management, and unlimited technological resources. And as I took a look around in my own country, I could see that bank borrowers had a safe access to credit. They could get the money they needed. But I couldn't help stop thinking about, what about the people that we declined? What about the people that were deemed too high risk? What were their options? When you start to think about it, millions of people don't have access to credit. If they had savings, they would use them. If they didn't feel ashamed and embarrassed to ask their friends and family to borrow amounts of money as small as $100 to $250, maybe they would ask them. Maybe if the headlines didn't shout out predatory and you're at high risk, maybe they would think about what the alternatives are. But with 45% of America living paycheck to paycheck and expenses rising, what happens should something unexpected come up? An emergency medical bill, a car accident, or just keeping your lights and water running. What are your options? A bank won't lend to you, credit unions won't lend to you, you have little to no savings. You're embarrassed to ask your friends and family to borrow a little money. So what do? You go get a payday loan, because it's your only option. The industry is huge, right? Listen, just to get a sense of the size. 14 million people, $45 billion borrowed last year alone, and it's growing. It's growing at double-digit rates year over year. But the problem isn't that it is growing. The problem is how it is growing. And when business and consumer interests aren't aligned, the consumers usually suffer. So if we're going to provide safe access in our communities to people with credit, what do we do? How do we change this product that we know is bad, but how do we not cut off access from those that need it the most, those that don't have any other options? So we need to ask three contentious questions and how to solve them. The first is, what is the right price for payday loans? Second is, how do you best deliver credit to people? And the third is there a way to structure these products that can build a better financial future for borrowers? So I'll start to address small changes that we can change the structure of payday loans from the first step into a vicious cycle of debt into an opportunity to build credit. And we'll do this with the story of one of our customers, and I'll call her Michelle. Michelle demonstrates the perfect example of how a payday loan can be good, but the fine line that separates it from the dangers and the debt traps that we hear about all the time. Michelle's a California resident, mother of two. She works full-time at a retail store, and that retail store has a cyclical business. And as such, Michelle's hours fluctuate month over month, but her expenses unfortunately don't. Michelle's been a payday borrower for years now. She took out the occasional loan when hours were low and bills were a little higher, or around the holidays when she needed presents for her kids. So for the occasional use, payday loans actually worked really nicely for her. The $15 payday fee was much cheaper than the $30 late fee or overdraft fee or bounce check fee. That can actually now be as high as $40 with some banks. And it was much cheaper than paying the late fee and the interest and the reconnect fees for cell phone bills or heating bills or electricity bill. So for the occasional use, Michelle saved that much needed extra money that she could keep food on the table for her sons. And then the unexpected happened. Michelle's younger son fell off his skateboard and landed in the emergency room with a broken arm. Fortunately, a few days later, he was fine, but the bill would be on its way. So what did Michelle do? She went to the payday loan store. She took out her loan. A month later, hours were still low at the job, and Michelle didn't have the funds to pay that back. So what did she do? She went down to the payday loan store and she asked what her options were. This is the pivotal moment. This is the moment that becomes what's known as the debt trap, when you can quickly get into trouble. So the options were rolling over her loan or taking out another one to refinance her loan. This is where you pay a little bit of money and your principal continues to grow and grow and grow. And this is where you hear those stories. You're borrowing just a few $100s and you end up thousands of dollars of debt. Michelle felt relieved at first because the disguise of flexibility actually meant that she was getting deeper and deeper into trouble. But she thought, God, I can save a little bit of money, keep money on the table this month. I'll worry about my finances next month. Too many financial products start with this introductory rate. I know you guys know them. You've all heard of them. Right? These teaser rates where you get your foot in the door, and then quickly through fine print or hidden fees, you accumulate all this debt. You're paying all these fees. But that's simply unfair. What should Michelle have done? What's the right price for Michelle? Payday loans are the only financial product today where you pay the same amount week after week, month after month, year after year. There's no segmentation. So what ends up happening with a fixed pricing scheme is you punish your best customers by rewarding your worst. Next is about what's the best way to deliver credit. The payday lending store is an outdated experience. Open from 9 to 5 when Michelle and other payday borrowers are busy working those hours they need to earn the next paycheck. It doesn't seem like this is necessary anymore, taking a bus or walking or driving down and waiting in lines to fill out all this paperwork just to ask for a loan or fill out an extension. With computer access becoming a given nationwide and mobile smartphone penetration increasing month over month, it seems like there can be a safe, dignified solution available 24/7 with a few clicks of a button or a swipe of a smartphone. Technology could have helped Michelle as she sat in that hospital emergency room, waiting her next step, wondering what her next steps would be. And the last, and arguably the most important, is about building credit. Most of the formal financial sector use credit scores from the major credit bureaus to make their decisions of who to lend to. But even today, credit access, checks, and credit reports are used by even more people, insurance companies, landlords, employers, to reach their verdict, creditworthy or less creditworthy, or even not creditworthy at all. What about Michelle? Michelle's had a history of paying on time again and again on the occasional use, but it's not shared anywhere. It's locked within the records of this payday lending institution where she went. So nobody else knows that Michelle is a good credit risk because this information isn't shared. Her years of on-time repayment behavior should give her the affordability of lots of options, but they're not. Her only option is to go back to that payday lender and ask them for an extension. Her options are based upon the goodwill of that particular payday lender who already has a monopoly on her limited options. So how do we afford the ability to build credit? How do we afford the ability to people to have their information shared? Well, payday lenders don't want to share this information because then they would lose their best customers. Right? So how do we enable this? I'll propose that by changing the structure of the loan product, by thinking about the customer as a relationship instead of a transaction, a product free of debt traps, available anywhere, that shares this information, we can change the structure of a payday loan from that first step of a vicious cycle of debt into an opportunity to build credit. But even with these fixes, it's not an end-all be-all to solve the solution. Fixing legislation is an important step for anybody in the political sphere out there. I mean, come on, credit is growing. We use credit, our grandkids are using credit. This is not going away. We need to enable a safe regulatory environment that allows access to credit, but still continues to provide safeties for consumers. And for educators listening, we need to incorporate financial education into our system and into our curriculums before we turn students loose on the real world. But aside from fixing legislation and education, we need to have a safe alternative, one that's available today for real people with real problems. There are a lot of problems in this world, and fortunately there's innovators out there trying to solve them. To quote the advice from Paul Graham, who founded Y Combinator, one of the most successful investors in helping people use technology to disrupt major industries, the way to get ideas is not to think of ideas, it's to look for problems, preferably problems you have yourself. It takes time to come across situations where you notice something missing. And often these gaps won't seem to be ideas for companies, just things that would be interesting to solve. Banks move slow, governments move slower. Innovators, however, can take risks, and it's in taking these risks, rethinking broken and how to fix it, that the most impactful solutions can arise. So when we started, we didn't think that by helping Michelle pay her monthly bills, we would solve some of the larger systemic issues involved with people that are denied access to credit. Sometimes rethinking broken can start by solving one person's problem and end up with greater implications. Payday lending was the problem that became my story. But when you look at your life and your problems, how can you rethink broken? Thank you.